Very good evening to all of you. Welcome to the virtual coaching class today. And we have been discussing profits and gains of business and profession. This is your third class for the PGBP chapter. Up till the previous class, obviously, we were discussing deductions. In the first class, we did the introduction to your PGBP and we did section 32. In the next classes, we did some specific deductions beginning from your section 33AB till 35D. In fact, 35D is the one which we will begin today. So before we proceed, again, the same drill, any questions from anyone related to the previous class, any topic you want to revise or any specific questions, any specific query? I hope you people are making small notes or small red flags or checking points which may be tested or which may be the main, what you say, the triggering point of a question to make a wrong answer or a correct answer. So today we will be beginning with section 35D. Again, I'll take a minute for any one of you, if any one of you have any doubts. And if you don't have any doubts, okay. Okay, Ambika, I'll revise sale of 35 AD. One second, students. Jay sir, tech team. One is that if it is used for non-specified business within that 8-year period, and if it is not used, okay. Now, if it is not used, the thing is very simple. If it is not used for any other business and you sell it, whatever proceeds you get would be your PGBP income. This is as per section 28. If it is used for non-specified business within the 8 years from when it was acquired, then two things will happen. Deduction would be reversed and there would be addition in the block of non-specified business, correct? Now, deduction would be reversed. How will you reverse the deduction? Whatever capital expenditure you have claimed as deduction minus depreciation, which otherwise would have allowed had 100% of the capital asset was not claimed as deduction. So if I purchase a capital asset on, suppose, previous year 18-19 for 50 lakhs, 10% depreciation. 18-19 पे I would have got 5 lakh का depreciation, and 19-20 में also I would have got on 50 minus 5, 45 पे I would have got 4.5 lakh का depreciation, this and this. But since I claimed 50 lakhs full 100% deduction, I did not get these, correct? But now when I'm reversing the deduction, 50 would be reversed, but at the same time, the depreciation which would have been allowed would now be taken from the reversal benefit, and net, which is your 40.5, would be your PGBP income. And the same value ka addition would be there in your block of the asset. Is it clear? Any doubts, Ambika? Please go through it. Ambika, definition of section 28 does not include sale of 3580. First of all, it's not a definition section, it's a charging section. Charging section means my PGBP income will include, and PGBP income includes the proceeds itself, full proceeds, no net of full proceeds. Others, any other doubt? Rule 6A, which is your 35 ABA. Okay, 1 second. I cannot see in relation to your 35 ABA for rule 6A if you're saying. 1 second, students. Okay. So rule 6A, when we talk in context of whether spectrum fee or telecom license, remember I told you that to claim amortization expense or the deduction expense under these, what is important is that the business should be commenced and the fee should actually be paid. So the actually paid thing is to be focused on to claim the deduction. To claim the deduction, the actual payment of fees is very important, and that is what is specified in your rule 6A. Any other doubts? So if you pay full fee, if you have paid at the whatever payment you make, so from the time you make the payment till the time the license is in force, you will get the deductions. If you pay it in parts, like the question we did of 9 lakhs, 9 lakhs and 9 lakhs, then whenever you make the payment, from that time the amortization will begin for that part of payment. Clear? Next, we proceed with now our section 35D, where we left. Now, section 35D talks about your amortization of preliminary expenses, amortization of certain preliminary expenses. Now, what are preliminary expenses? We understand when in relation to beginning of some certain expenditure, beginning of some certain venture. If you are like commencing your business, that is preliminary expenses. Whatever you do before that, like when you're an Indian company, drafting of MOA, AOA, your legal expenses, registration of companies, all are those your preliminary expenses. But also preliminary expenses in case of non-corporate can come into picture. Ma'am, how come preliminary expenses in case of non-corporate can come? When suppose there are two cases, when either you are starting a new project, when you are starting a new project, or you are extending your business by bringing in a new unit. So in those cases, obviously, when you will take a new project or when you are starting a new unit extension of the business, obviously you will do some feasibility studies. You will prepare feasibility report, you will prepare project report, you will get due diligence done. All of these costs comes as your preliminary expenses. So preliminary expenses, if I talk about, are either allowed to Indian company only or allowed to strictly resident non-corporate. That means non-resident do not get the reduction of 35D. Secondly, I told you if you're commencing the business or you are extending into a new unit or new line or you are commencing a new project. Only in these scenarios, whatever expenses would come would categorize as preliminary expenses for your section 35D. So if you come up with the issue of share capital, it will not be a preliminary expense. It will not be a preliminary expenses. Whatever expenses happen before the beginning of these, whether commencing your business, whether extending a new unit, whether a new project, those expenses will be your preliminary expenses. Now, how do you get the reduction of preliminary expenses? The preliminary expenses, first we'll calculate the qualifying amount, which I'll tell you what is this. You get the reduction in 5 installments, in 5 equal installments, 5 equal annual installments, beginning from the year when you commence the business or your project is completed to begin or extension is completed to begin. From that year, you will get the deduction of preliminary expenses in 5 installments. So if I begin from previous year 1920, previous year 1920 would be the first year to get the deduction. Then previous year 2021, 21-22, 22-23, and 23-24. In all those years, 1/5 each, I will get the deduction. Now the question comes, what is the qualifying amount? 1/5 of what? The qualifying amount, basically the amount which is allowed as deduction, would be either the preliminary expenses or 5% of your cost of project. 5% of your cost of project. 5% of your cost of project. But if you are a company assessee, then instead of 5%, you have a choice. Please listen carefully. If you are a company assessee, then either you have a choice to take the cost of project or capital employed, जिसका 5% would be higher. Usko you will compare with your preliminary expenses and then take the lower. I'll repeat. Generally, the qualifying limit is preliminary expenses, that is the actual kharcha which you did, actual expenses which you incurred, or 5% of the cost of project. But if you are a company assessee, then it is Indian company, then it is at your option whether to take 5% of cost of project or capital employed. And obviously, which one you will pick? The higher one. Why? Because higher the limit, higher would be the chances to get the qualifying limit. Okay? And then from whatever comes, you'll take the lower and 1/5 each you would claim for 5 years. Is it clear? Now question comes, what is cost of project? When I say cost of project, whatever the amount or the value of fixed assets which are there in that new project or new unit would be your cost of project. When I say capital employed, what is capital employed? Share capital plus long-term borrowings. would be my capital employed. If we are talking about preliminary expenses in relation to a certain project, then share capital plus long-term borrowings for that particular project or for that particular unit. Reserves and surplus will not be part of your capital employed. Any doubts? And yes, whenever you are claiming such deduction, then audit is mandatory in the first year. Audit is mandatory in the first year. Now suppose I began my business in previous year 18-19. I'm an Indian company. I started my business in previous year 18-19. Now in previous year 2021, I got amalgamated with another company. X got amalgamated and now XY is there. Okay. So now in the year of amalgamation, now in previous year 18-19, I would have taken one installment. In previous year 19-20, I would have taken the second installment. Now in previous year 2021, who will get the installment? The amalgamating company will get the installment, or the amalgamated company will get the installment, or proportionate installment would be there. So as per 35D, the new company will get the installment in the year of amalgamation, get the benefit of deduction in the year of amalgamation. The old company will not get any deduction, meaning thereby in previous year 2021, the 1/5 of installment, which is the third installment, would be given to XY and not to X. Complete as if XY was the company who has incurred such preliminary expenses. Is it clear? Remya, I'll come to your question regarding 41 when we will do 41. Okay? So there could be a better clarity for all of them. But students, today class would be really interesting. We'll be doing some different types of expenses today, and it would be really interesting and more than relatable than telecommunication license. Clear? Next, we move ahead to next deduction, which is your 35DD. Now, again, the coming to all are those in relation to the amortization of expenses. First, 35D was amortization of preliminary expenses. Now, 35DD is for amortization of expenditure in case of amalgamation or demerger. It is pretty much obvious that on amalgamation and demerger, again, some core expenses in relation to amalgamation or such business succession happens. Now, the point comes, who will claim the expenditure? How this expenditure can be claimed? First, the assessee who incurs the expenditure will claim the deduction. So if in case of demerger, the demerged company has done all the expenditure, then they will claim the deduction. If the resultant company has done the expenditure, the resultant company will claim the deduction. Similarly, for amalgamation, amalgamating company if has done the expenditure, they will claim the deduction, or the amalgamated company has done the expenditure, they will claim the deduction. Secondly, again, deduction for amortization of your amalgamation expenses or demerger expenses goes in same 5 installments. In 5 installments beginning from the previous year when such amalgamation takes place. So if amalgamation takes place today, as in previous year 2021, so in previous year 2021 you will get 1/5, and in the next 4 years also you will get 1/5 of the reduction for amalgamation and demerger. But here the point to remember is only Indian company which incurs such expenditure will get the deduction. It's not that always resultant company or the amalgamated company will get it. Clear? Next is your 35DDA, amortization of expenditure incurred under voluntary retirement scheme. Now, how many of you understand what VRS is? What is VRS? So VRS is basically when you give the options to retire pre the age, as in retirement age is 58. So pre their retirement age, if they want to retire, or abhi recently, not very recently, but BSNL's was in news for VRS given to its employee. So instead of them to get retired at a later age, they give the option to VRS. Now VRS, mein what happens? You give a huge amount of accumulated part of salary to the employees, as in remuneration for the early retirement. Now this huge amount, which has to be spread out over the years, is now given out as one. So now this expenditure which has happened on VRS will again be allowed as deduction, but not in one go, in 5 goes. That means in 5 installments, beginning from the previous year when this VRS is taken up, and the next for previous year. Again, just like 35D, if the amalgamation or demerger happens, the new entity, the new successor will get the deduction for that particular previous year. The predecessor will not get the reduction in that particular previous year. A question can come to get the deduction, so specifically an MCQ. So please be very careful that successor will get the deduction, predecessor will not get the deduction when it is 35D or 35DDA in case of amalgamation or demerger. 35DDA covers more scenarios like succession, conversion of your firm into LLP, or your firm into company, or companies into LLP. All those are covered here. Any doubts? Now we are doing something really interesting now, section 36. Now section 36 subsection 1 goes with various number of subsection clauses, and these are really interesting ones, really relatable one, and really important one, and very common also. So I hope everyone will now give their 100% attention on the screen. Good, Ambika. Section 36 is commonly called as other deductions. Abhi tak, if you can just take a second and revise your memory, what all deductions have we covered? We have covered depreciations, we have covered specific scientific expenditure, specified business expenditure, then others may be covered your amortization of expenses, then we covered your telecom license amortization or spectrum fee amortization. We covered specific deductions which are there into tea, coffee, rubber development, manufacturing. Then we covered in the last class while going, we covered some agricultural extension project and skill development project. These were the major deductions which we covered. If I say except depreciation, you may have not seen others in your common practice, right? But now other deductions and 37, there are the two just deductions sections left, which will cover the major chunk of deductions which any business claim during their activity period. So let's begin. Now everyone will ask, ma'am, whether we need to remember these clauses, whether we need to remember all of them. See, again, as much as you can remember, well and good, but for bad debts and provision for bad debts, I will tell you which section is there. Please try remembering that. Okay? So now let's begin. Section 36 subsection 1 clause 1, premium paid in respect of insurance against risk of damage or destruction of stocks or stores used for the purpose of the business or profession. So basically stock insurance, basically your stock insurance. Building insurance is covered in the section 30. Plant and machinery insurance is covered in your section 31, right? So now stock insurance is covered in my section 36. Then we come to if you are a cooperative society and cattle is your main business income generating, as in into your milk federating society, cattle is your main business income generating tool, right? So insurance of the cattle becomes a deductible expense under section 36, under section 36 subsection 1 clause 1a. Next, section 36 subsection 1 clause IB. If you have anyone who has been working into some good company insurance company profile, they get group insurance coverage. The employees get group insurance coverage. So now consider yourself as employer. Obviously you will be paying insurance premium for the group health insurance. Group health insurance means your employees health insurance. You pay a lump sum mota amount of insurance premium for your employees health insurance. I'm not saying life insurance, health insurance. So this premium which you pay every year for the insurance coverage of your employees, you will get the deduction for the same. But the condition is the premium should not be paid in cash mode. It can be paid in any mode other than cash. Obviously, the insurances which you are talking about should be the one which are approved and regulated by the IRDA. Clear? Now, more interesting part coming up. Section 36, subsection 1, clause 2. Bonus or commission for services paid to employees. Now, bonus or commission for services paid to employee. Let me write it here. Section 36, subsection 1, clause 2. Any amount of bonus, any amount of commission you are giving to your employees will be covered here. Now, first thing, commission to other agents will not be covered here. Only commission to employees and bonus to employees are covered here. To get the deduction in this section, what is important is that before filing of the return, such bonus and commission should actually be paid. That means it should not be a credit entry, but it should have been paid to the particular employees. Secondly, it is immaterial whether this bonus is as per Bonus Act or not, but what is important is that it should not be an appropriation of profit. That is, instead of giving of dividends or giving of distribution of profits, you are giving bonus. That should not be the cunning case. It should be in the nature of bonus and commission, and it should be actually paid before filing the return, basically before your due date. Then only you will get the deduction under section 36(1) clause 2. Okay, so there's a question where, one second. Okay, so Amika asked that, ma'am, in section 35 DDA, even if transfer takes place in the middle of the year, then also the successor will get the whole deduction. The answer is yes. Whether it's 35D or 35 DDA, if the amalgamation happens or the demerger happens in the middle of the year or even at the closer to the end of the year, always the successor will get the deduction in such event, in the year when such events take place. Unlike your depreciation where the deduction was proportionated, here only the new entity, as in the successor, will get the deduction. Okay, so now we begin to next section, 36. Clause 1 clear, insurance premium of stock. Clause 1A, insurance of cattle. 1B, insurance of employees. 2, bonus or commission. Next is 36(1) clause 3, interest paid in respect of capital borrowed. Now again, this is basic 11th concept that in P&L you take your revenue nature interest, otherwise you capitalize your interest. If it's in relation to the borrowings are in relation to certain capital asset, you will capitalize it. If the borrowings are purely in the nature of running of your businesses, you will take it into revenue. And if you remember, while we were doing section while we were doing depreciation and we were discussing the actual cost of the asset, in explanation we did discuss that the interest which is paid from the time of the loan which is borrowed till the time the asset is put to use is capitalized. Once the asset is put to use, after that any interest, it will go into my P&L account, and it will go into my P&L account means that it is a deductible expense as per section 36 section 1 clause 3. Is it clear? Otherwise, all other interests which are covered here, specifically the deduction would be allowed if the capital which is borrowed is used for the purpose of business or profession strictly. Also, I'm doing it here, but then when we'll be doing section 43B, we will discuss that there also. But if anyone of you are referring to module, please write section 43B also will come into picture. So what is section 43B? First, I'll let you guys know. Section 43B is just a conditional section which says that certain expenditure, even if allowed from section 30 to 36, will be allowed only if they are actually paid before the due date of filing of return. That is what the crux of that section is. So in that section, one, bonus is covered. That bonus should be actually paid. Similarly, interest is covered, but only interest which is paid to bank, your PFIs, your SFIs, your NBFCs. Only those interests are covered here. That means, please listen carefully, students. If I have to claim the deduction of interest, then that interest should be paid on or before the due date of filing of return, number one. Number two, that interest which I'm referring here is the one which is paid to bank, PFI, SFIs, and NBFCs. If I take a loan from my friend for the purpose of business and pay him interest, but that interest is unpaid, that interest is unpaid till the time of filing of return, will I get the deduction? The answer is yes. Why? Because the condition of section 43B is only restricted to the interest paid to these entities. And why only restricted to these entities? Because they want to encourage the flow of payments in the economy. CK people claiming deductions and not paying interest for years. That's why they have to encourage such habit. They have made a condition on claiming the deduction that you will get the deduction only when you pay it. Okay, so if I take an interest from my friend and it is unpaid till the time, if I take the loan from my friend and the interest is unpaid till the time of filing of return, it will not matter. I can claim the deduction provided the interest is fair enough, as in it is reasonable. But if I take it from bank, I have to pay it to claim the deduction, the interest part. Any doubts, students? Okay, so now we proceed to next. Pro rata amount of discount on zero coupon bonds having regard to the period of life is allowed as deduction under section 36 subsection 1 clause 3a. Now, how many of you know what is zero coupon bonds? Zero coupon bonds are an instrument for short-term financing. Number one, what happens is there is a company which need immediate funds. Okay, so what they do, they issue bonds. Please try understanding. This will help you in capital gain also. They issue bonds to investors and then they get money. Okay, I am X company. I needed funds. I issued bonds like a paper that I have your money and they get the money. Okay. But now what happens in zero coupon bonds? They are basically no interest bond, but what here the cost comes to the company is the discount amount. Is the discount amount. What is discount amount? These are the bonds which are said to be issued at discount and redeemed at par. Issued at discount and redeemed at par. Ma'am, what do you mean? I'll tell you. When I issued bonds, the amount which I get from investors is 90 crore. Now, when I have to redeem, basically, when I will redeem the bonds, I will pay them 100 crores. So they were issued at discount, but they are redeemed at par. So as a company, the cost for me is that 10 crores. Which if I would have taken a loan of 100 crores at a 10% rate, would have come as 10 crore to me. But zero coupon bonds are for a short term period, generally less than 12 months, and immediate funding is done. So that's why you get less money, but when you pay it at full. So that difference which you are paying is your discount amount, which is the cost to you, which is the cost or the expenditure to you. First of all, did you get the understanding of zero coupon bonds? I'll repeat again. Yes, Sabita, absolutely right. No interest is given, but obviously the cost comes to the company is the discounting factor. Again, I am the X company. I need funds. So for getting funds, I issue bonds to the investors. Investors give me money, but investors give me money at a discounted amount, that is 90 crore. But when I have to redeem them, that is when I need to get the bonds redeemed, just like repayment, when you say you make full payment, you make full payment of 100 crores. So for you, the cost is this 10 crores. For you, the cost is this 10 crores. Now, zero coupon bonds are not issued by any such companies, only which are issued by your infrastructure capital company are considered here. Not any company are issuing zero coupon bonds. It is not happening. Okay. So now this 10 crores is my cost, is my expense. I am X company. How will I claim the deduction of this 10 crores? So they say that this deduction is allowed on pro rata basis. This deduction is allowed on pro rata basis having base regarding the period of such bonds. Now suppose if these 10 crore bonds were issued for 10 months. So at the beginning of the period, I will get 90 crore. When I have to redeem, I will pay 100 crores at the end of 10 months. So this 10 crores, which were issued for the period of 10 months, will be divided over a period of 10 months. That means each month I will get a deduction of 1 crore. Now you will ask that what is the relevance of month when we follow years? Students, it may happen that these 10 months are covered in two different previous year. Suppose in previous year 1920 and previous year 2021. So suppose I issued the bonds in February, which would be redeemed by December. So 2 months are coming here and 7 months are coming here. 8 months are coming here. Right. So 2 months, 2 crore will go in my previous year 1920 as deduction, and 8 months will go in my previous year 2021 as deduction. Is it clear? This will be November. Is it clear? So simple, sir. You will get. You need to calculate the discount amount, which is basically the cost. Pro rata it over the month period. Just be careful if the months are falling in two different previous year. Next is my next deduction is now very important and very interesting one. How many of you understand the concept of provident funds? Section 36, subsection 1, clause 4 and 5. They say, again, to understand this, please take yourself as the employer. Take yourself as the employer. Now, any contribution to an approved recognized provident fund, to an approved superannuation fund, to an approved gratuity fund would be allowed as deduction. Any contribution of the employer would be allowed as deduction if it is an approved fund, number one. If it is an unapproved fund, you will not get the deduction. Don't think yourself as a person from salary perspective, that is the employee perspective. Please try thinking yourself as the person who's the employer, who also make the contribution of the equal amount in most cases to such approved funds. I am employer, you are employee, okay? So I will be making contribution to such fund, right? Matching your contribution. So the contribution which I make would be the deductible expense if it is made in an approved fund, which is your recognized provident fund, superannuation fund, and gratuity fund. Number one. Number two is that such contribution should be, again, section 43B will come here also. Such contribution should be made on or before the due date of return filing. Clear? Any doubts? So, Abhi, employer contribution is allowed as deduction if it is in an approved fund, number one. Number two, if it is made on or before the due date of return filing. Clear? Now, students, what about the employee contribution? What about the employee contribution? Now think whether the employee contribution, whether I'm giving it from my pocket. No, I'm not giving it from my pocket. I take it from the employee, and then I have just basic liability to deposit it in the fund account. Employees do not directly deposit it in such funds. They give it to their employer. Then employer with his own fund goes to that, with his own contribution, goes to that fund and make that contribution there. Correct. So employer contribution is allowed as deduction. What about employee contribution, which is with employer? You gave me the money. Okay. You gave me the money to make the contribution. The moment you will give me the money, it will stand as a credit, correct? This would be allowed as deduction. That means this would be deductible only if it is deposited in such approved fund within due date of fund. Within due date of fund. This is my section 36(1)(5). I'll say again. Employer ka contribution, so I have to give it from my own pocket. I am the employer. This is the fund. Okay, I have to give it from my own pocket. Whatever I give, I will get deduction provided it is an approved fund and it is within the due date of filing of return. Clear? Now your contribution, you are the employee. You give me the money that I have to deposit it into this fund. If I do not deposit it, it would be my income, right? But if I deposit it and to claim the deduction, your money has to be deposited within the due date of fund. Ma'am, why due date for employee contribution and why due date of filing of return for employee contribution? See, due date of fund means Provident Fund ka what is the due date to file? To make the contribution 15th of every month, correct? So by 15th of every month, I have to make the your contribution deposited in such fund. And why such date? See, here income tax understand that this you have to give it from your own pocket. So that's why you may need extended time. Fine. You need to arrange funds. So that's why we give you the time to claim deduction. That is if you make the contribution by this date. But in this scenario, you have already taken the fund from employee. The only duty of yours is to make the same deposited in the fund, right? So why should we give you the time period till return filing date? We give you the time period only till the due date of such fund, that please deposit the same within the due date of that particular provident fund or that particular superannuation fund to claim the deduction. Clear hua? Yes or no? Please take a look at this. इसमें again contradictory judgment है where Delhi High Court says that due date of fund, it is not due date of fund, it is due date of return filing. That is a contradictory judgment, but your module, your act says due date of that fund. Do you want me to explain it again? Please take a look first. Yes, Ambika, for the zero coupon bond, always you will calculate pro rata monthly basis and then you will give the deduction. Because generally it is a short-term financing, so it will always be less than 12 months. Take a look, students, and please tell, is it clear or not? Both the scenarios, yes, no. She's okay, Anjali. Okay, everyone on the screen, please. I am the employer, you are the employee. This, you know, that every month the contribution goes to an, suppose we have a provident fund in here, okay? Every month the contribution goes, correct? I will take the your employee contribution, which you get in ATC deduction. That is the story. Okay, ATC may you get the deduction. So employee contribution and employer contribution, every month both the contribution goes in the fund, correct? Now employer contribution, I am the employer. Who is running the business? Who is running the business? Employer is running the business, and we are doing deductions for the business. Okay, now I am the employer. If I need to claim the deduction of my contribution, which I have made a contribution, right? I have made a contribution to the Provident Fund, right? So if I need to claim the deduction of the contribution which I made, I have to deposit this money in an approved fund, number one. Second, this money has to be deposited on or before the due date of return filing under section 139(1) to claim the deduction. Clear? Now we come to the other party. Abhi, also we are still claiming the deduction as per the business only, from the employer's perspective only. Now you gave me the money, this money which is your contribution. Now, if I do not get this money deposited within the time frame of the fund, this would become as my income. Because I had your money, only duty of mine as an employer is to deposit your money in this fund account, right? To deposit your money in this fund account. So the employee contribution which I get, I have to deposit it within the due date of this fund, and every month 15th is the due date for Provident Fund. So within 15th of every month, if you give me the money on 1st of the month, first I have to get it for the month, say you give me the money on 1st December for the month of November. Okay? So I have to deposit that money by 15th of December. Otherwise, the money, the employee contribution, even if I get it deposited later, would become as part of my income. It would be not be a deductible expense. Is it clear? Employee, when he will file his return, he will claim this as a deduction in ATC, uska contribution. But here we are taking it from the perspective of business. One which is going from my pocket, another which is being given by you, but has to be deposited by me only within your due date. Is it clear? Do not think of ATC right now. You want me to explain through entries? I'll explain that also. Savita, see, if employee contribution is deposited after due date of that fund, then this would be a non-deductible expense. That means whenever you are doing the audits, specifically tax audits, many of people tend to ignore this point. Please bring the Provident Fund account statement from them. Whatever the contribution has been done in the employer by the employer before return filing day, allow it. Whatever contribution of employee is deposited, whatever the contribution of employee is deposited after 15th of the month, please disallow it. Please disallow it. See, I'll tell you how the entry goes. Salary account debit to employer's contribution payable. Suppose employer contribution is 12,000 rupees. Okay? Now, if this employer contribution ka entry payable is done, suppose 31st October is the date. No payable is there, or the payable is done by 31st October 2020, this 12,000 would be allowed as an expense. Number one. Now, when we get the employee contribution, how this happens is you basically reduce your liability for the employee. Employee account debit to employees contribution payable account. Now, this employees contribution payable account should every month by 15th be cleared. Okay, so please, whenever if you're doing any tax audit, please be very careful of this point. Is it clear? Yes or no? What all funds are covered here? Your Provident Fund, your superannuation fund, and your gratuity funds. Preeti says, ma'am, why will company claim employee contribution income is shown less in this case? Why will company claim employee contribution? Okay, everyone gets this confusion. See, students. Okay. You are an auditor. You saw credit entry. Credit entry means you got money from the employee. Okay, you are the auditor, you got money from the employee. First reaction of you would be, please add this back in my income or reverse your salary expense. Correct? But then you as a businessman says that this is the employee contribution which I deposited it within the time frame. So then they say, okay, I have taken this entry. Now we will give it as deduction under section 36(1) clause 5A. This is what happens. Yes, people tend to get confused that income, why are we treating? This is how it happens. The expenditure is deductible. That means otherwise it would be treated as income in the case of employees' contribution. Take your time. Any doubt now? Preeti, is it clear now? Okay, sure. Now, see, this is a tricky point where people get confused because maybe you may have not dealt with Provident Fund and all in your articleship. That's fine. Now, next is again something on the same line, but employer's contribution to new pension scheme, NPS, which is allowed as deduction under section 80 CCD to the employee. Now, how many of you have an idea? I'll quickly tell 80 CCD at one side. Now, 80 CCD mean what happens? This contribution is allowed, this deduction is allowed to employ. This deduction is allowed to employ. What happens? The employer contribution. Now, think yourself as employee to understand this. Employer contribution is added in salary. Salary income में ऊपर it is added. ठीक है, gross total income it comes added. Then the same is employer contribution is deductible under section 80 CCD. Is deductible under section 80 CCD to the extent of 10%. This happens, and your own contribution as an employee is also deducted under section 80 CCD. So you as an employee gets this deduction. Again, I repeat, for the employee part, 80 CCD mein what happens? First, any contribution of the employer to NPS. Now, employer is not making contribution for himself. Ultimately, who will get the benefit? You will get the benefit. All the paisa from this fund will go to you only. All the money from this fund will go to you only. Okay? So that's why employer's contribution is treated as income. Whether if it is, even if it is Provident Fund, it is treated as income and then it is exempt up to 12%. If you will remember, 12% up employer's contribution is exempt in salary. Similarly, the same thing happens in 80 CCD. Employer contribution added in salary because he has made a contribution for me. The same gets deducted after gross total income in 80 CCD. And also the contribution which you for yourself made is also deducted under section 80 CCD. Okay? Clear? This is what happens in employee's personal income. Why I told you? So that now you can relate it better. Now I am the employer who is making the contribution. Mere liye to it is expense. For me it is an expense. I am making a contribution for my employees' benefit to new pension scheme, NPS, Atal Pension Yojana. Okay? So whatever contribution I make will be allowed as deduction subject to it is 10% of salary. Subject to it is 10% of salary. That means employer's contribution deduction for NPS cannot exceed 10% of the salary. So, and salary for this purpose is salary plus DNS allowance of retirement benefit. So the employer will get the deduction of contribution which he has made to NPS for up to 10% of salary. Now, if I take a question in this regard, just 1 second. Why is so slow? See, X Limited contributes 20% of basic salary to the account of each employee under a pension scheme referred to in section 80 CCD. Okay, they are making 20% of the basic salary. DNS allowances 40% of the basic salary and it forms part of your pay of the employees. That means it forms part of the retirement benefits. Compute the amount of deduction allowable under section 36 subsection 1 clause 4A if the basic salary of the employees aggregate to 10 lakhs Would disallowance under section 48(9) be attracted, and if to what extent? 10 lakhs is the basic salary. Actual contribution is how much? 20% of the basic salary. He has done 2 lakh, right? But allowed contribution would be, as per section 36 subsection 1 clause 4a, would be 10% of basic salary plus DNS of retirement benefits. And retirement benefits, DNS allowance of retirement benefit is 40% of the basic salary. So 10% of 14 lakhs, which is my 1.4 lakhs. But the contribution happened is of 2 lakhs. Section 36 is the section of allowable expenditure. So the allowable expenditure is 1.4 lakhs. What is the disallowance? The excess part. Excess part is my disallowance. So 2.2 lakhs minus 1.4 lakhs, 60,000 is the excess amount, which would be disallowed. And disallowance of this happens under section 40A subsection 9. Now, please, my dear students, do not make this error that in your tax treatment, either you will just make the deduction of 1.4 lakhs, or what you will do, you will add 2 lakhs and show the disallowance of 60,000. Either in dono में से just do one thing. Please do not do you deduct minus 1.4 lakhs and then you add 60,000. So net impact of only 1.4 lakhs will come in your profit. Is it clear? Yes or no? DNS allowance is also allowed. Basically, contribution, sorry, not DNS allowance. Contribution to NPS is also allowed, but it is allowed only up to 10% of the salary plus DNS allowance of retirement benefits. Next, we move ahead to next section deduction. Which is my deduction under section clause 6, animal used for purposes of the business or profession otherwise as stock and have died or become permanently useless for such purpose. Now depreciation may, if you guys remember, plant and machinery may, we specifically excluded livestock. Now, if I'm into a business of circus, right? If I'm into a business of circus, plant animals are my main source of income, right? Now, at the time of purchase of animals, I cannot claim it as deduction. I cannot claim depreciation. What will happen? Now, animals, I have purchased them for a huge price. Now, what will happen? I want to claim the deduction. So they say the animals' cost are allowed as deduction only once, and that happens when they become useless, absolutely useless for the purpose of business, or when they die, only then the cost of that animal would be allowed as deduction. Obviously, if by selling the carcass of that animal, if you're getting any amount as recovered, that would be net off. Next, very important sections. Next two are very important sections. So if up till now you have any doubt, please ask. Okay, now a few doubts for ATCCD I have. First is what is section 49? Okay, one by one. Section C. Students, your allowable expenditures are up till section 30 to 37, you can say, and your disallowances are covered in section 40 Section 40A. So Section 40A says that whatever contribution to NPS is over and above 10% would be disallowed under subsection 7. Okay. And section 36 on the other hand says that allowance is only to the extent of 10% of salary. So whatever is allowed will go here. Whatever is disallowed will go here. So if the question asks you about if the MCQs ask you about the allowance part, you will give the only allowance part, which would be this 1.4 lakhs in the case. If the question asks about the disallowance part, then you will take the actual part and the allowed part. The excess amount would become the disallowed, not 47, 49, sorry. The actual part would become the disallowance. Simple. So whatever the question asks, just give them that. Okay? But do not say, suppose 2 lakh is already deducted in your profit. 2 lakh is already deducted in your profit. A good comprehensive question is there. Now what will you do? You will add 2 lakhs and then you will deduct 1.4 lakhs, right? This is one approach. Or second approach is you directly just disallow 60,000. Don't do both the adjustments in your P&L. Okay? Clear? 80CCD is not a section under which the employer take the benefit. 80CCD is for employee. Why I told you? So that you people can take it better. Employee in his personal return will take. Now, bhai, employer has make a contribution for me. First, I will add that in salary, and then I will get a deduction of the same in my from my gross total income. Okay. Again, everyone is asking, ma'am, do we need to remember the clauses? Again, I'll say bad debts ka and provision for bad debts ka, which we are doing now, is very, very important to remember. Otherwise, as much as you guys can, totally you will. But again, do not quote the wrong sections. Do not quote it all, but do not quote the wrong one. So now Muthu, Savita, Sandeep, Ambika, all of your doubts clear. Shall I proceed now? Because the coming section is an important one. Okay, Savita, practically what happens is you are an employee, I am the employer, I will make my contribution and your contribution I will basically deduct from the final payment which I have to make to you. This is how it happens in practical life. Okay, so now we begin with another important section, very, very important section, section 36, subsection 1. Sorry, section 36, subsection 1, clause 7. Bad debts. इसमें क्या है मैम? Bad debts is very simple. 11 say we are doing accounting entry for that. I know. Now bad debts. First, bad debts are allowable expenditure. Bad debts are my allowable expenditure from my profit. Number 1, if they are actually written off in the books of accounts. If they are actually written off in the books of account. Number 2, only those bad debts will be allowed for which the impact has been taken in income. What is this second line? Actually written off means that I have to pass the entry in my books of accounts. I have to pass the entry in my books of accounts that this amount, so and so debit amount is now written off. This cannot be recovered. Second is that only the bad debts which are in relation to my income would be allowed as deduction. What do you mean? I'll tell you. There is a person, Mr. A, to whom I made a sale of 50,000. When I made the sale, I would have added in my income, correct? Now this Mr. A is untraceable for years. Now I write him off in my books of account. So this 50,000 is a allowable expense as per clause 7. Clear? But now another example. There is Mr. B, whom to whom I gave a loan of 70,000. To whom I gave a loan of 70,000. He's in my advanced party. Okay? He's my, I have given him advance or a loan of 70,000. Now, when I gave him a loan of 70,000, nothing has been impacted in my income. Correct. Now, Mr. B, my life is so bad. Mr. B is also untraceable now. Mr. B is also untraceable. Now, I will write it off. But will I get the deduction of this? The answer is no. Why? Because I have not treated that as income. So, how can I claim the expense out of that from my profit? I treated 50,000 in my income, whether in this year or in the preceding previous year. That is fine. But this 70,000 never passed through the P&L account. It was always a capital loss, right? It is a capital. It is by asset, right? I never passed it in my P&L account. So this, if goes bad, will not be given as expenditure as per income tax. But if it goes back, will be given as expenditure in my income tax. Number 1. Number 2, no provisions are allowed. Only the actual bad debts are allowed. No provisions are allowed. Only the actual bad debts are allowed. That means whatever actually happens, only that I cannot make a provision for bad debt account and claim that expenditure as deduction from my profit. Clear? Number 3 is my bad debt recovery. Now suppose in previous year 1920, I had to take from Mr. C 3 lakh rupees. Then there was lot of fights. 3 lakh I had added in my income. He's saying I can only give up to 2 lakh. I cannot give 1 lakh. Please write it off in your books of account. So in 1920, I wrote off. Again, I'm saying writing off that bad debt in books of accounts is a precondition to claim the deduction. So I wrote off 1 lakh rupees in my books of accounts. I wrote off 1 lakh rupees in my books of accounts, and in 1920, I claimed the deduction of 1 lakh. Clear? Now cut to previous year 2021. What was the debit balance remaining from Mr. C? 2 lakh now. Now Mr. C got lucky. His business furnished again and he gave me 2,40,000. He gave me 2,40,000. Okay. So now 2 lakh up. Simple, so if I make an entry, Mr. C was, as the end of the year, was standing at a debit of only 2 lakh rupees, right? Now, when I receive this 240, I will make an entry of cash account debit 240, correct? To Mr. C account of 2 lakh. Why? Because only 2 lakh is pending. And the remaining would be my bad debts recovery. Would be my bad debts recovery of 40,000. So this 40,000 would be my income as per section 41, deemed income. And we are doing section 41 side by side. Yes. So we did section 41 in case of sale of scientific research asset. We did for balancing charge, and this is your third one, recovery of bad debts. So now if the bad debts get recovered, then they would be treated as income in the year of recovery, irrespective of the fact whether you're doing the business or not. You have to show this as income. The idea is whoever claim the loss of bad debts will show the income of bad debt recovery. Now, suppose the firm had claimed the bad debts, but the recovery is done by the partner, then the firm will not show the recovery. Who gets, simple concept, students, who gets the loss will pay for the taxes also if recovered. Who do not get the loss will not pay for the taxes. Simple. So up till now, is it clear? Yes. Now another example of bad debt recovery only, which tends to confuse. I'll take the one which are there is in your module. Now previous year, 1920 May, total bad debts was of 75,000. Total bad debts were of 75,000. But the income tax officer, as in the assessing officer, allowed under section 36(1)(7), only 40,000. So allowed was only 40,000, but actually was 75, but they allowed only 40,000. They said, okay, we cannot trust you on the remaining 35,000. We think you may recover it, whatever the reason is. Okay? So they allowed only 40,000. Now what happened? Bad debt recovery happened of 44,000 in previous year 2021. Before I explain you, I want you to take a thought and tell me that what is the income as per section 41(4) for bad debt recovery. Jot this down and think and tell what is the, apply your mind once, what is the bad debt recovery which would be taxable under section 41(4). What is the bad debt recovery to be taxable in the year 2021? Is it 40,000? Is it 44,000? Or is it any other amount? This is very common MCQ question. So please try attempt it. Okay, I've got few answers. 40,000 would be liable as income. And then someone has said 9,000. Okay, interesting, very interesting. So the correct answer is 9,000, which would be only taxable. Why? I had claimed that there are two approaches to explain. I'll explain both of them. I had claimed how much amount of bad debts? 35,000 as 75,000 bad debts. But income tax allowed me only to the extent of 40,000. So there was a disallowance of 35,000. Already 35,000 ka to there was a disallowance. Now I have received 44,000. And now I have received 44,000. So over and above the disallowance which I have received, disallowance means that part was treated as income. Disallowance means that part was treated as income, right? Now, if I'm receiving something over and above that amount, only should be taxable. So over and above the disallowance amount, only should be taxable. That means only 9,000 should become taxable because it's 44,000. So you can say 35,000. So I already got disallowed. So now only 9,000 should be taxable. If suppose what has happened? If suppose I have bad debts recovery was of 38,000. If the recovery was of 38,000, then how much would have been taxable? Then how much would have been taxable? Only 3,000. If the recovery was of, say, 32,000, How much would have been taxable? No amount would have been taxable. Now, how did I try to understand when I was in my tax classes? Simple. I used to do proper accounts. I used to say that total bad debt was 75,000, but they allowed only 40,000. That means in my books, good debit must have been standing for 35, which is the disallowance amount, right? Now, when I'm recovering something, 35,000 again, this entry, I used to apply this entry, cash account debit to the balance which is already outstanding. Excess amount would go to my bad debts recovery account. So 9,000 is the correct answer. समझ आया या नहीं? ठीक है. So this is your very good question and very common question of MCQs. So now please be very careful. Just do not just read it and write the facts, think, and then make the correct option as the choice. Savita, then Preeti, Ambika, now is it clear? Savita, 9,000 was the correct answer. Why did you change it? So 3617, Sandeep, you have to remember this section, okay? These are really important sections. Now, did you understand? Yes or no? Let me just test you. Yes, yes, no. Tell me, what would seem? I'll tell you. Okay. Total bad debts were of 1,20,000. Allowed as per assessing officer was 75,000. Allowed as per assessing officer was 75,000. Now, tell me what would be the income chargeable under section 41 subsection 4 if there is a recovery of 59,000. If there is a recovery of 59,000. Good. Good, Preeti. Very good. Is it clear now? Every one of you, 14,000 is the correct answer. Over and above the disallowance, whatever you get is your bad debt recovery when in case of such disallowance happens. Okay? Clear? Yes. So back to the concept where I started, I told you that bad debts actually written off are allowed, provisions are not allowed. Only when bad debts, if are in relation to the one which have been taken an impact in your income. So if they are in relation to your loan, then that would not be allowed. But if loan giving is your main course of business, but if providing loan is your main course of business, then obviously such bad debts would be allowed. If you are a financer, then any bad debts in relation to loan would be allowed because loan giving and taking is your main course of business. Okay? Last point before we take a break. Provision for bad debts is allowed. I'll leave it here at suspense, but it is only allowed for banks and financial institutions. We'll discuss that. But last point before we take a break is in relation to ICDS. ICDS are what you need to compute in relation to all these plus, minus, addition, deductions, and all. You need to compute your income as per the income computation and disclosure standards. Okay. Now, suppose the condition, a case law comes and there's just one page ka study material ka part. So please try understanding. ICDS is just like my accounting standards are there for my accounts. ICDS are standards for my computation of income. Now, suppose as per ICDS, I have considered some income. Okay, ICDS said that consider the income. So I've considered an income. Okay. Now, as per books, I have not considered the income. The income is not considered. Income is considered as per ICDS. As per books, it is not considered. Simple, clear. Now, what happened? The income which was considered as per ICDS goes bad. That means the ICDS wala income is now irrecoverable. But books mein to you have not taken that income, right? Books mein you have not taken the income, so you cannot write it off bad. And the condition as per section 36(1) clause 7 is that it is important to write it off in the books to claim the deduction. It is important to write it off in the books to claim the deduction. But books mein to income has also not gone. So what should we do? Whether we will get the deduction because we have not written off it in the books. So they say if any such situation only in case of ICDS happens where the income has been treated as per ICDS and books mein there is no impact, then bad debts would be allowed if they are bad as per ICDS. Simple. So all in all, writing off in the books would be allowed as a relaxation when the bad debts has happened as per the income, which is only considered as per ICDS, which is only considered as per your ICDS. So there is this whole, if you will study, and those who study after the class, if you will read, there is this whole one page on it so that people do not get confused. This is what this part says. In other things, again, students writing off in the books is the main condition. Assessing officer will not ask for the proof that shows the proof that this is bad. No, if you have written it off in your books, it is sufficient that it is a bad debt. Okay, so with this note, we'll take a 10-minute breaks. After that, we'll be discussing the provision for bad debts, which are only allowable in case of your banks, SSCs, your financial institutions, and your NBFCs. So see you in 10 minutes. Have a good time. Refresh yourself. Yes, sir? Yes, sir? Welcome back after the break, students. I hope you people got refreshed and now back to the topic. Before going to the break, we were discussing bad debts, and the last point which we discussed was for ICDS. In your module, which is there somewhere around 96, 97, you will get this ICDS wala part. So with an example for you, see if the ICDS told me to consider revenue of 50,000. Abhi books may have not made the entry. 1 second. Okay, so in my books, I have not made the entry of this 50,000 because I have only considered it as per my income computation and disclosure standards. Now this 50,000 goes bad debts, okay? But now if you are an auditor, you will find the book, the entry in the books of accounts, and there is no such entry in the books of accounts because there was no such income. So will you allow it? Because even if it is not written off, the answer is yes. If the bad debts are as per the income, which is considered only in ICDS and not in the books, then even if it is not written off in the books, still ICDS deduction would be allowed. Clear? Next, we move ahead to the provision of bad debts. Section 36, subsection 1, clause 7A. Subsection 1, 7. So I told you provision is not allowed to you and me and SSE, but only the ones who are into the business of banking, financial institutions, your NBFCs, all of these are allowed the provision for bad and doubtful debts. Okay, so now how are they allowed the provision? The provision for them is a straight amount. So if it's an Indian bank, if it's an Indian bank, and by Indian bank, I mean scheduled bank, non-scheduled bank, cooperative banks, all of them. And if it's a foreign bank or your PFIs, public financial institutions, state financial institutions, state industrial investment corporations, and non-banking financial companies, NBFCs. DHFL, Indiabulls, all of these are your NBFCs. Okay, so there are two categories of creation of provision. For Indian banks, the provision is 8.5% of gross total income before claiming deduction under Chapter 6A, and obviously before claiming deduction of provisions of bad and doubtful debts. And for them, it is 5% of gross total income. So if the gross total income is 10 lakh, 5%, which is your 50,000, they will get as deduction. Here it is 8.5. But Indian banks, again, see, Indian banks are more exposed when it comes to risk, are more exposed to risk because of their rural banking. Obviously, we all know when it comes to rural banking, the risk of bad debts becomes more. So they, in addition to this 8.5%, also get 10% of aggregate average advance made by rural branches. Aggregate average advance by rural branches. So meaning thereby, whatever rural branches are the ones which are in the area of a population of less than 10,000. Okay? So whatever rural branches are there, all the rural branches का monthly average लेना है. Okay? Monthly average का average लेके all rural branches का advance section का, advances means their loan section का average and aggregate of them means all rural branches का sum का 10%. So 10% of aggregate average advance of rural branches plus 8.5% of GTI would be my total provision of bad debts allowed as per section 36 subsection 1 clause 7A. But when it's foreign banks, PFI, SFI, SIIC, NBFCs, only 5% of GTI is allowed. Number 2, you will not make different provision account for rural advance and other advances. Only one provision account has to be maintained for claiming the deduction. Second thing is, how many of you remember this? A T-shaped account of provision for bad debts. So, now there's a provision for bad debts account. There must be, or let's not take T-shape. Let's show you like the other way. Both are very correct. There's an opening balance. Now every year provision is going. Opening balance of provision. Then you create a new provision, right? Then actual bad debts happen, right? And then you come to the closing balance of provision. Is it correct? Yes or no? Now, think and tell. I will get the reduction of this new provision which is created as per section 36(1)(7)(a). Correct? Now, actual bad debts happen. Actual bad debts happen. Now, what would be the first thing? I will adjust it with the provision. Now, will I get the reduction of this actual bad debts? If adjusted with the provision, the answer is no. Because provision while creating, I had already claimed the reduction. While creating the provision, I have already claimed the reduction. Now, if actual bad debts happen, will I get the reduction again? The answer is no. I will not get the reduction again. But suppose if my opening plus new provision is of 200 lakhs, but bad debts happen to the extent of 230 lakhs. My opening and new provision are of 200 lakhs, but bad debt happens to the extent of 230 lakhs. Now, the excess over provision will definitely be allowed as deduction. The excess over provision would definitely be allowed as deduction. Again, simplest thing. I have been claiming deductions for the provisions. Now, when actual things happen, if it is met by my provision balance, I will not claim the deduction. I will not think the deduction, but actual bad debts is more than my provision, then obviously whatever excess loss has happened over and above the deduction which I have been claiming, I can claim this. So this 30 lakhs will go in my which section? Section 36 subsection 1 clause 7, which is my bad debts ka section. 7A is for provision for bad debts, 7 is for bad debts. So on this note, let's do a question. Everyone on the screen, please. The following are the particulars in respect of a scheduled bank incorporated in India. Scheduled bank means 8.5% of the gross total income plus 10% of my average balance, aggregate average rural advances balance. Provision for bad debts and doubtful debts up to assessment year 2021 is 100 lakhs. That means the opening balance. Gross total income is, before deduction, is 800 lakhs. Aggregate average advance made by rural branches of the bank is 300 lakhs. Bad debts written off for the first time in the books of account, that means your actual bad debts in urban advances only, is 210 lakhs for the previous year 2021. First of all, this in respect of urban advances is just given to confuse you. I told you there is a one single provision, whether it's for urban or rural it does not matter, number one. So this is just to confuse you. Second thing, before I see step 4, my first thing is to see what is my opening balance and what is my new provision. Opening is 100, new provision would be 800 ka 8.5% plus 300 ka 10%. 98. Now, opening amount was 100. New provision is of 98. That is for the year. As per section 36(1)(7)(a), I will claim this deduction. I will claim this deduction. Okay, 198. But actual bad debts happened of 210. Actual bad debts happened of 210. But my provision is only up to extent of 198. Provision is only to the extent of 198 means that I have only claimed the deduction till 198. So 198 ko to I will not check, but over and above the provisions, which is 210 minus 198, 12 is my actual bad debts over and above the provision, which I will claim under section 36(1)(7). See students, 210 में से 198 का already provision से I have taken the benefit. Remaining 12 को I will claim under section 36(1)(7). So closing balance of my provision would be nil. Correct. Now next year, whatever the provision happens, whatever the actual bad debts happen, if actual bad debts are more than the provision, the excess part would go in my bad debt wala deduction. The other is adjusted through provision. Why you create provision? You create provisions for the uncertainty only. While creating the provision, you are getting the deduction. So when actual uncertainty happens, you will not get the deduction until and unless the actual uncertainty, which is the actual bad debts, are more than my provision amount. Is it clear? Yes or no? Ambika, is it clear? Okay, if current bad debts are 100, so my actual current bad debts can be set off with this. Closing balance would be 98 for previous year 2021. Till the time my actual bad debts are, and I will not claim deduction of this 100 anyway. Till the time my actual bad debts are meeting my provision, I will not claim the deduction of actual happening. See, I am claiming the deductions on uncertainties. So when they become certain, it would be a matter of double deduction because uncertainty ka bhi I am claiming, certainty pe bhi I will claim. Only I will claim the excess amount. Okay, so again, see simple people, simple maths. How do you make a T account? For any credit thing, opening plus additions, right? Minus the deduction. Deduction, I have created a provision. This provision is for uncertainty. Now, if uncertainty happens, if this provision can meet it, fine. If this provision cannot meet it, the excess amount would be claimed as deduction. I have already asked the income tax to give me one, give me 98 as to give me 98 as deduction, because bad debts may occur, so it's better you give me the deduction. Now bad debts occurred and they occurred for a value of 210, but this is 98 this साल का provision, remaining unused provision of the last year is 100, so 198 is only the deduction which is unused for the uncertainty, and uncertainty happened to the extent of 210. I had claimed only 198 from the income tax authorities for bad debts, but bad debts actually happened to the extent of 210. So the extra 18, extra 12 which has happened should be allowed as actual bad debts, but only to the extent of the extra happened. The other actual bad debts have actually been adjusted through the provisions for which I have already claimed the deduction. So in the previous year 2021, what will happen? First, I will create the provision and I will claim the reduction of provision under clause 7A. Now, by the end of the year, when the actual bad debts happen, if they are over and above my provision ka balance, so I will claim the excess amount in my actual bad debts. Because again, be it any provision, students, not only provision of bad debts, be it any provision. Okay, okay. I'll stop share and then I'll do it again. So everyone, is it clear now? Savita, is it clear, or I can take another example also? Okay, this means claim shall be like this: 100 as provision and 12 as bad debts. 100 as provision, 100, no, 100 was a different example. 210 में से see, opening was 100. I created 98. Now actual bad debts का entry will pass by provision if I'm claiming it from the profit. Actual bad debts की entry would be provision account debit. I'm writing ulta, sorry. Actual bad debts की entry now will, what you will do, provision account debit to actual bad debts, which you are adjusting through the provisions. So actual bad debts happen to the, as per the question, actual bad debts happen to the extent of 210. Provision is only of 198. Remaining, where will you adjust? In your P&L account. In your P&L account. Bas, so you debited your P&L account with 2,10,000. Now is it clear? There was a technical glitch earlier. Students, let's take case scenarios. Okay? Let's take case scenarios so that once and for all it gets clear. My opening is 100 lakhs. My new provision is 210 lakhs. Actual bad debts happened. Case 1, 310 lakhs. Case 2, 260 lakhs. Case 3, 540 lakhs. Now, before taking the benefit of actual bad debts, first you create this year provision always. So this year provision will always go in my deduction of clause 7A because I'm a bank. Now, actual bad debts happen to these extent. Now, I have a provision which is unadjusted with any liability to the extent of 310 lakhs. Now, tell me what would be the deduction under section 36(1) clause 7 for actual bad debts. Will it be 310 lakhs? Will it be 260 lakhs and 540 lakhs, or will it be any other amount? As again, I'll say this is a simple maths ka problem, a simple accounts ka problem where you have created a provision. You are getting the deduction for provision. We're not taking the scenarios where you do not get the deduction of provisions. We are taking the scenarios where you get the deductions of provisions. Already, it's just like similar to what we did in other things. When while creating provision, I have claimed the deductions, then why should, while having the actual expense, I claim the deduction again? Why should, while having the actual expense, I should claim the deduction again? Because when I've already claimed deduction while claiming the creating the provision, now when the liability has materialized or when the uncertainty has materialized, why will I claim it again? If I have to claim it, I will claim only over and above what have not been claimed, right? And over and above what have not been claimed would happen in this case only in case 3. Correct? Yes or no? So this is it. That's it. This is about your actual and provision. Now, if is it not clear, then also please do not hesitate. I will do it again. Even if single one of you says that it is still an issue, I will still do it again. But please do not say we have got it until you have not. Because these are actually the ones which comes as MCQs. Savita, no, not the correct answer. Preeti, correct answer. Ambika, very good, correct answer. Very good, Preeti. Then Sumit, is it clear? Yes or no? Tell me now. Still, few of you, Savita, is it clear? Yes or no? Don't worry. See, simple. If I'm not claiming any deduction of provision, I'm not a bank. I'm a simple person who's into a textile business, not claiming provision benefit. Whatever actual bad debts happens is my allowable deduction, but I'm already claiming the benefit of provision. Here I'm claiming the benefit of provision. What is provision? Provision is what is there for uncertainties, and I'm already claiming uncertainty ka provision. Now when certainty materialize, whatever can come under this provision, whatever can met is fine. Over, suppose it's just simple like that. I have claimed the benefit of 540, as in I have claimed the reduction of 540, but I have incurred the loss of 600. Where would the remaining 60 go? 60 would actually go into the actual section. Those will be met by the provision. That's it. So this is what your question for provision and actual bad debts will come. And if it is yes, still not clear, take a deep breath, go through a question once, and then let me know if it is not clear. Before ending that topic, I'll do it again. Before, as in when I take the last call for the doubts, please tell me then. Okay? And specifically, I'm waiting for your reply. Again, in all this, students, please be very careful. New provision ka deductions go in my section 36, subsection 1, clause 7A. Excess provision, excess actual dates ka deduction goes in my actual bad debts wala section. Okay. Next is my transfer to reserves. So Rita, the answer of this question is this written here direct on the screen. Don't worry, I'll do it again at the end of the class. Just ping me if it is not clear then. Now we move ahead to section 36, subsection 1, clause 8. Section 36, subsection 1, clause 8. Students, just like provision is not allowed to all the entities, it is allowed only to the banks or who are into a long-term financing. Similarly, this section is also allowable only to the specified entities which are there in the finance or long-term financing or your financial corporations. Again, appropriation of profits. Appropriation of profit is what? Giving dividends, transferring it to reserves. Giving dividends or transferring it to reserves are not your deductible expenditure, right? Similarly, but in case of finance, long-term financing entities, which are your specified entities, transfer to reserve is also a deductible expense. Only for specified entities, transfer to reserve is also a deductible expense. Transfer to reserve is also deductible expense. But how much is deductible? Lower of actual amount transferred to the special reserve or 20% of the profits from eligible business. That means PGBP ka 20% before claiming this deduction, obviously, or 200% or twice of your paid up share capital. I'll write it first and then I will break it for you. Paid up capital plus general reserve minus aggregate amount in reserve. Let me just break it for you. Sorry. Okay, so I told you that whatever amount you transfer to reserve, listen to me and then correlate. Whatever amount you transfer to reserve is allowed as deduction only if you're a specified entity. By specified entity, mean banking company, public sector company, cooperative banks, your financial companies in which are into financial corporations, housing finance companies. Okay. Whatever amount you transfer to reserve to the extent of 20% of your PGBP is allowed as deduction. So if I can just simply say 20% of profit, maximum up to 20% of profit. Provision के case में you made it as a percentage of gross total income, but here it is percentage of your PGBP income, number one. But at any time the deduction will not be allowed the moment reserve balance is up to twice of paid up capital plus general reserve. Reserve ka balance gets twice of my paid up capital or general reserve. So where the aggregate amount of this special reserve becomes twice of my capital plus general reserve, then the reduction would not be allowed. So maximum up to 20% of PGBP, but the aggregate amount, that is the amount which is there after all the transfers throughout the year, cannot be more than twice of capital plus general reserve. Cannot be more than twice of capital plus general reserve. So सोचने का बात है, the moment this special reserve is getting twice as of your paid up capital and reserve, which is a huge thing. Bas bhai, ab we will not give you the deduction. This is what the income tax says, that this is the maximum deduction you can claim till the time the balance of that reserve goes to twice of your paid up capital and general reserve. Is it clear? Just like recovery is taxable of bad debt, similarly, when I make a transfer here, I'm getting the deduction. Yes. When I'm making a transfer to reserve, I'm getting a deduction. The moment I make a transfer from reserve, the moment I make a transfer from reserve, that would be treated as income. That would be treated as my income. When I'm transferring it, I'm getting deduction. So when I'm transferring from, it should be treated as my deduction, my income under section 41. Clear? Yes. Next is my see, again, these special reserves are created so that as a finance company, you still have profit segregated. Again, just like provisions are there. See, finance companies are again exposed to a lot of risk. So if you have reserves for future contingencies, more the better is. And why will they make an investment in reserve when they get the deductions for making such investments? That's why they will put a separate part of their profits in some special reserve account. For contingencies, again, yes. Next is my section. Now it's very easy one. 36(1) clause 9. Expenditure on family planning by a company. So when I say by a company, this is only for company SSE. Number 1. Number 2, here revenue expenditure is allowed 100%, but capital expenditure is allowed 1/5 every year for 5 years. Allowed 1/5 every year for 5 years. This is only when a company assessee makes an expenditure on family planning, for its employees. Then whatever expense has happened in that family planning drill, revenue expenditure full allowed, capital expenditure allowed up to 1/5 every year in 5 installments, beginning from the year when the expenditure has incurred. Next is your expenditure incurred by entities established under any central, state, or your provisional act. Any central entity, any state entity, or any provisional entity, whatever expenditure they do is allowed to them. Whatever expenditure they do is allowed to them. So all their expenditures are allowed, and any notified entities which come into this section is also allowed. CBDT, not CBDT, Central Government recently notified Oil Industry Development Board, OIDB, that OIDB, whatever expenditure they will do, automatically everything would be allowed as per the provision of clause 9. Next is contribution paid by public financial institutions by way of a contribution to such credit guarantee fund trust for small industries. Simple, in a simple way, not very important, but the section says that whatever public financial institutions are giving as a contribution to a credit guarantee fund trust would be allowed as deduction. Clause 30, section 36 subsection 1 clause 15 says securities transaction tax paid and commodity transaction tax paid, which is the next one. Very, very important to understand this, that STT and CTT are allowed as deduction only to those assessees whose income from such transactions is taxable in my PGBP. What is STT and what is CTT? Excuse me. Sorry. What is STT and what is CTT? Security transaction tax is when you trade into recognized stock exchange, you have to pay a 0.1% something for this transaction which has happened. Uspe you pay the tax. Commodity transaction tax is when what you pay when you trade in commodity derivatives. Both are these are again in relation to transfer of shares or derivatives on stock exchange. It would be a deductible expense only when the income from this trading of stock shares or commodity derivatives is your PGBP income. If it is your capital gain income, it will not be deductible, or it will not be a deductible expenditure at all. Clear? So expenditure is allowed as deduction only when its income is taken into that particular head. Last two, 36(1) clause 17, expenditure incurred by a cooperative society engaged in the business of manufacture of sugar for purchase of sugarcane at a price which is equal to or less than the price fixed by or approved by the government. Very absurd section. What is it? See, government fixed the price at which you can purchase. If you're into a business of sugar, you can purchase the sugar cane. If you purchase it at a price less than the price which is given by the government, us purchase ka you will get the reduction. Last, marked to market loss, MTM loss, marked to market loss, section 36, subsection 1, clause 19. This is 19 or 18? 18. This is 17, no? Sorry. Clause, section 36, subsection 1, clause 18. Mark to market loss is not allowed in income tax. In fact, before ICDS, mark to market loss was not allowed. What is mark to market loss? These are notional losses. Whenever you carry some investment as a business, in your business dealings, every time when the investment is marked to the current price, any loss or gain is taken into account. That is notional. You're not selling it. You are not you're not selling it or dealing in it. Whatever you're doing is every day you mark it to the current market price or the current quotation price. So this marking may obviously sometimes, suppose I purchase it for 10,000. Now the current closing price is 7,000. Now the current closing price is 7,000. So this 3,000 ka, which is mark to market loss, is not allowable anywhere. But if it is as per ICDS, then only it would be allowed. If any ICDS allow this loss, then you will claim it as the deduction. Otherwise, you will not claim it as deduction. So big question can come to you in which it can be written mark to market loss of 4,000 as per ICDS of 2,000. So how much will you allow? Only 2,000 amount. The other would be disallowed. Clear? Now I'll take a quick recap of section 36(1). Very quick recap. First three are for insurances, stock, cattle, and the health insurances of the employees. Next is for bonus and commission. For bonus and commission, it is important that it should be paid before return filing date. Section 40, return filing due date. Interest paid to capital account, capital borrowed solely for business purposes is to be considered as deduction. But if the loan is taken from state, from public financial institutions, from banks, from NBFCs, then interest would be allowed as deduction only if it is paid before return filing date, due date of return filing. Zero coupon bonds, discount prorated over monthly basis is allowed as deduction. Recognized Provident fund approved superannuation fund, approved gratuity fund, contribution of employer is allowed as deduction. Again, section 43B comes into picture. Employee's contribution towards pension scheme is allowed as deduction, provided it is up to 10% of salary, and salary is basic plus DNS allowance of retirement benefit. Employees contribution, please write here employees. Employees contribution to gratuity fund covered here. Employees contribution to any provident fund etc. would be allowed as deduction, or if it would be treated as income if it is not deposited within the due date of such funds. Animals are allowed as deduction only when they die or become useless. Bad debts are allowed as deduction which are actually written off in books and are in relation to the income which has been credited in your books of accounts. Provision for bad debts is allowed only to banks, Indian and foreign, NBFCs, financial institutions, public and state, and SIIICs. Okay, this is allowed up to 8.5% of gross total income plus 10% of your aggregate average advances. Only for Indian banks. Foreign banks and others are allowed 5% of the gross total income. Actual bad debts over and above these provision would be allowed under section 3617 if you are claiming the provision as deduction. Special reserve up to 20% of the gross, 20% of the PGBP profit is allowed as deduction, but at any time the aggregate special reserve ka balance should not be twice of my paid up plus general reserve. Family planning, revenue expenditure fully allowed, capital expenditure in 5 installments. And if any unabsorbed is carry forwarded, capital expenditure any unabsorbed is carry forwarded for an indefinite period. उसके बाद STT and CTT are important only if you are into the business. That means you take the income of such sale in your PGBP income, then only it would be taken as deductions, and mark to market loss only as per ICDS would be taken as deduction. Ooh. So tell me, what is the doubt, if any, under section 36? It is very interesting section. I specifically like section 36 because I can actually relate to it. Any doubts? Chalo. Next, we move to another section, which is my section 37. It is a general section of deduction. Now, close your eyes and think, may not close your eyes, but take a sit back and think where a salary paid to employee, basic salary paid to employee will go as deduction. From section 30 to 36, whatever we have read, can I take basic salary paid to employee in any of this section? There is no provision as such. So where all these deductions goes? All these deductions goes in my general section, which is section 37, which says clearly few things and very general few things. All the expenditure which is in relation to the business of the assessee, which is in relation to the business of the assessee and is in revenue in nature, as in revenue expenses, not capital expenses, would be allowed as deduction if it is incurred by assessee, during the previous year, would be allowed as deduction wholly and exclusively for the business and profession purpose. Again, it should not be any personal expenses. It should not be any prior period expenses. It should not be any capital expenditure. It should not be any illegal expense. Illegal expense means you are purchasing XYZ thing, you are hiring gundas, their expenses will not be allowed as deduction. Okay. Few case laws come specifically from section 37 because it's a general section. So lots of interpretation can go here. Number one, explanation which is incurred is if expenditures is incurred by an assessee is an offense or is prohibited by law, it shall not be allowed as deduction. It shall not be allowed as deduction. Prohibited by law means any law which is in force. If it is prohibited, it will not be allowed as deduction. Most common example and case laws come is see, have you visited any doctor, I hope not in the recent time, but before Corona, if you visit any doctor, lots of representatives from so many companies comes, okay, and just before your appointment, they enter the cabin of the doctor. What happens is they give freebies. Freebies can be in the nature of any mug, any pen, calendar, anything, clock, whatever they which has their name, and then they tell that we also produce so and so medicine, so you can recommend it to your patient. This is what happens generally. Okay. Now this freebie is an expense for the person who is sending that representative. I am the person who sends such representative with such freebies, right? I printed clock with my brand name over it and I send it to 100 doctors. Okay? These are freebies. But that freebie obviously is an expenditure for me. Will it be allowed? The answer is no. The answer is no. Why it will not be allowed? Because as per medical profession, as per my medical profession, medical conduct, distributing freebies to doctor is illegal. Distributing freebies to doctor is illegal. It is not allowed, illegal as in it is not allowed per the medical conduct. It is not allowed as per the medical conduct. So anything which is prohibited under any law will not be allowed as an expense, even if it is for my own business, even if it's an advertisement for my own business, it will not be allowed as an expense. Number one. Number two, but this freebie ka cost would be taxable in the doctor's hand also. Huh? This would be an income in the doctor's hand also. Number two, there's a Capsman company ka case where a laboratory pays referral commission. Many a time you go to a doctor, if they need to get a test done, they get so and so test conducted from that laboratory, from that lab, right? So why do they write the lab name? Because they get commission for such referrals. Now this laboratory is having person coming and getting tested. For them, laboratory ko to they are getting business, so they give commission. So they give commission to the doctor, but this commission is an not deductible expense for the laboratory. Why? Because again, referring by the doctors for a lab is prohibited under medical conduct, and any expenditure which is prohibited under any law is not allowed as deduction. Clear? Next explanation. See, more the general section is, more the case laws will be there for them. Next explanation is in relation to your CSR. Companies Act, CSR. Now, as per Section 135 of the Companies Act 2013, every entity having a certain crores of net worth or certain crores of turnover or certain crores of profit has to give 2% of their average 3 net year profits in CSR, right? Now the question comes whether these CSR activities are allowable expenditure. See, CSR activity you are doing as per Companies Act, right? And obviously you will be spending good amount over these social responsible activities. Now, whether this is allowed as per your income tax, the answer is no. Because after a lot of deliberation, but they said that this corporate social responsibility is a appropriation of profit. It is not a expense for business nature. It is an appropriation of profit. You had profit, that's why 2% of that has to be appropriated to a CSR activity, right? If you did not have any profit, you will not do it, right? So this is an appropriation of profit, and this is not an expenditure for business for it to be allowed under Section 37. For it to be allowed under Section 37. So CSR ka deduction is not allowed. A question will come This means CSR amount would be given as deduction. So you will not claim it as deduction, you will disallow it as per explanation 2 to section 37. But students, one thing, if suppose, remember we did agricultural extension project. Now, if the person has done a CSR, listen carefully. If a person has done a CSR by making any expenditure which is allowable under section 32-36, which is allowable under section 32-36, then he will get the deduction under those particular sections. So, as a CSR activity, if a person invests in an agricultural extension project, which is an allowable deduction as per section 35 CCC, right? Yes, right. So this is an allowable deduction of 100%. Then in that case, this would be allowed 100% under section 35 CCC. If, again I repeat, if any CSR expenditure is done in relation to expenses which is allowed from 30 to 36, then they will get a deduction under that particular section, because that is allowable as per those sections. In general, CSR otherwise is not allowable. Clear? Next here is for which is your key man insurance policy. How many of you understand what is a key man insurance policy? Students, key man insurance policy is a policy which the business gets. Generally, companies may, there is a key man. Key man is the one who is vital for the running and success and survival of the business. Okay, one, you do the employees' health insurances, that is different thing. Here you secure the life of a key man, the man who is main for your business, the man who is main for your business. The expenditure on key man insurance policy, that is, suppose I am a company, I have this CEO without whom the business cannot survive. So for me, that CEO is my key man. So as a company, I will get his insurance done. So whatever amount I'm getting, whatever amount of premium I'm paying for that key man would be allowed as deduction to the company, would be allowed as deduction to the company. Second, when this policy matures, whenever this policy matures, if the maturity amount comes to me, that is the company, then it is the income as per section 28. Then it is the income as per section 28 on maturity. If it goes to the key man, the CEO, the maturity amount, then it is his salary income, profit in lieu of salary. If you have read section 17, you will get to go there. What did I say? This is my key man. I'm getting his insurance done. The insurance premium is allowable expenditure under section 37. Number one. Number two, now the life insurance policy will get mature. If the company gets all the paisa for that, it is the income of the company, taxable as per section 28, charging section. If this CEO gets all the money, he has got all this money. Why? Because he was my employee, my key man. So whatever he has got is in lieu of his salary, then it would be taxable as his profit in lieu of salary. Clear? Again, all these points, students, tax is all about just relating one section to another, relating a TDS section to your business expenditure section. Then only it will be more interesting, it will be more relatable, and the concepts would be more clear. So the more people ask me how to remember the sections, I say just try relating it as much as you can. If you see some section in capital gain which is related to your PGBP, try relate it, try remembering it. You will definitely get all them. Correct, Preeti. I drink a lot of water, so I hope you people excuse. Now, last is your advertisements in souvenirs of political parties. Now, if I am an SSC, um, I get my advertisement done in a souvenir of a political party. That, as a contribution to that political party, that would not be allowed as deduction under my PGBP. It would be a not allowable deduction. So, any advertisement for the political parties will not be allowed as deduction, but yes, it will go as a contribution under section 80GGB or 80GGC, which is in your political parties contribution deduction. Clear? So this is all about my section 30 to 37. All over, one thing is common is that only the expenditures which are there in relation to your businesses are only allowed. Nothing over and above the businesses are allowed. Nothing over and above which is not for the purpose of business or which is of the nature of capital expenditure, all of these are not allowed. If you're claiming any deductions while creating just like in tea coffee, while making a deposit, then you make an actual expenditure, then you don't claim the deductions. Just go by the flow, try understanding it as a business SSC, you will relate more. Again, all these allowable deductions may happen, have already been taken as an impact in the P&L statement which is given in front of you as a question, then do not make a double adjustment. That means it is correct. But if the adjustment has not happened, then you will allow such deductions. Clear? Now, basis this understanding, let's see how much of you remember whatever has been done. So I'm putting you on the screen, as in the question is on the screen. Try relating it and tell me the correct answer. All the sections which we have done in the past 2.5 classes is covered here. One second, students. Showing 1 second. The question is the net profit is for the financial year is 35,25,890 after debiting the foreign items. That means all these impacts have been taken. all these impacts have been taken in this profit. Now, whatever should not be allowed is the one only to be added back. So now purchase of raw material used for the purpose of in-house research and development, including GST of which is not admissible of 1,80,000 on which ITC is not admissible. You will claim the reductions of 11,80,000 full. GST on which ITC is not admissible is an expense and can be claimed under section 37. Then purchase of price of asset for in-house research and development, land and building. Both of them has been debited to my profit of 8 lakhs. But land is not allowed, so I will add land ka value back. Next, expenditure incurred on notified agriculture extension project, 25,50,000 is allowed. Next is my expenditure on notified skill development. This may be purchase of land. There is purchase of land, and then there is expenditure on training for skill development. So expenditure on training would be allowed, but land ka cost would not be allowed. Then land would be added. Then your expenditure incurred on advertisement in software published by the political party, not allowed. We just did 75,000. Expenditure incurred on issue of right shares. Expenditure incurred on issue of debentures. Think, abhi tak, is there any section in which we discussed about this? Iska I will come. Iska I will explain and then we'll do it. One second, I'm just opening your questions. Iska I will tell you, penalty under GST Act not allowable. Any penalty is not allowed. Penalty paid for breach of contract with a customer 40,000. This is allowable. This again I will explain you why. Interest paid on a loan taken from bank for a payment of advanced income tax. In business purpose, the expenses is not allowed. Any loan taken for that expense would also not be allowed. I'll come to this. Provision for loss on subsidiaries also not allowed. Now to issue of shares and debentures. Sorry. Okay, students, now few things. When we talk about shares expenses in IPO, in for the public offer, in initial public offer, in further public offer, or right shares. These result in my increase in capital. This result in my increase in capital, share capital, and hence it is not allowed saying it's a capital expenditure. But when it is buyback, bonus specifically, or debenture, then it is treated as of the nature of revenue nature, because it does not increase my capital amount, or there is no change in my share capital. There is no change in my, sorry, I'll write it clearly. There is no change in my share cap. That's why. Okay, so this is what the stand comes when such expenditure is there. That's why debenture ka it is allowed and right shares ka it is not allowed. Another thing, students, when I talk about penalty, penalty which is prohibited by law is not allowed. Please write it somewhere because I know it may tend to slip off the mind. Penalty for law will not be allowed, but penalty paid for a breach of contract. Penalty paid for breach of contract will be allowed. Will be allowed. Clear? So if just isme, just like in the question, just like in the question, the penalty was paid for breach of contract with customer, that was allowed, but penalty for violation of law of GST was not allowed. Okay. Then for another thing, income tax related, income tax is my tax on the income. Any tax amount, any interest amount, any penalty amount will not be allowed, will not be allowed. But if there's any indirect tax, this I'm not getting the input, the tax and interest would be allowed as expenditure. So interest on late payment of GST would be allowed, would be allowed. Penalty of any nature is never allowed because penalty is violation of law, that is not allowed. Is it clear? Will you people will remember it? Chalo. Next, we proceed to the sorry. See, wherever there is an increase in share capital, IPO, FPO, right shares, the expenditure will not be allowed because it is a capital nature. But whenever there is no change or whenever there is a buyback, bonus, or debenture, it would be treated as revenue nature and the expenditure would be allowed. Students, the class might extend till like 9, 10, 9:15 because another topic which is inadmissible deduction is very important to be covered. Otherwise, the next class will go, we have the last segment for the next class. So before that, these have to be covered. Okay. Now, till 37, the everything is over regarding admissible deductions. If this is condition is fulfilled, you will get allowed. Now we proceed to section 40. Where they say inadmissible deduction. That means if the conditions are not fulfilled, any deduction allowed would become inadmissible. That means any deduction allowed will become disallowed, would become disallowed. Any deductions allowed would become disallowed. Any expenditure allowed would become disallowed. All of these are under section 40A clause 1 and so on. So 40A clause 1 talks about if, first of all, it covers only the payments which are made to non-resident or which are made to any person outside India, number one. Any payment of interest, royalty, fee for technical services or other sum chargeable. If it is paid without deduction of TDS, without deduction of TDS. Students, TDS is important and to make people compliant that they should deduct TDS at the time they are bond to, they have come up with an inadmissibility that if you will not deduct the TDS, you will not get the expenditure as deduction. So if on a payment to a non-resident or outside India, I do not deduct it. I do not deduct, or if I deduct it and did not pay to the government, before filing return, before the due date, then such expenditure would be disallowed. So suppose I have paid a royalty to non-resident and I have not deducted the TDS, then this expenditure would be disallowed. Even if it is an admissible deduction, it would be disallowed under section 40A clause 1. But if if I deducted in the next year or deducted in the previous year itself and deposited it after return filing date, then the deduction would be allowed for the same expenditure in the next year. Ma'am, what do you mean? Let me take an example. In previous year, 2021, I made a payment of 3 lakhs of royalty to Mr. Joy. Okay? I made a payment of 3 lakhs of royalty to Mr. Joy. I did not deduct the TDS and I obviously did not deposit it. Now for the previous year 2021, this would become a disallowance. But suppose on December 2021, I deducted the TDS on this 3 lakhs. So whatever was disallowed in the previous year would be allowed in this year. Whatever was disallowed in the previous year would be allowed in this year. Again, I'll repeat, if any expenditure is disallowed under section 48 clause 1 because of it being not deducted or deducted but not being paid, then whenever the same is paid or whenever the same is deducted or whenever the same is paid would be allowed as deduction in that particular year. But now tell me one thing. I deducted it in previous year 2021 on March 21. Okay? And I deposited March 2021 and return filing due date is 31st October. I deposited it in July 21. In which year I will get the reduction? I will get the reduction in previous year 2021 because I have deducted it in the previous year and deposited it by the return filing date. I have deducted it in the previous year and I have deposited it by the return filing date, correct? Now, second example, I deducted it in previous year on March 2021, but I deposited it on 30th December 2021. In which year I will get the reduction? In which previous year I will get the reduction? In previous year 21-22, because I had, even if I had deducted in the previous year 2021, but I did not deposit it before the due date of return filing date. So in previous year 2021, that expenditure would be disallowed. But in previous year 21-22, I will get the deduction for the same. Is it clear? Next scenario. In previous year, the expenditure of this 3 lakh, इसी पे I am taking the doubt, ठीक है? I deducted it in previous year. Please listen carefully. This 3 lakh I deducted it in April 21 and deposited on July 21 as and the return filing due date is 31st October 2021. I'll say again, this 3 lakhs of royalty which I paid to Mr. Joey in previous year 2021, the expenditure of it was deducted in April 2021 and was the TDS on the same was deducted in April 2021 and was deposited in July 21. In which year I will claim the reduction of this 3 lakh? Previous year 21-22. Ma'am, why? Because he has, even if he has deposited the TDS by before the return filing due date, the answer is the condition to get is that if you make no deduction or if you deduct it in the previous year and deposit it in the deposit it before the return filing date, then only you will get the deduction. Otherwise, you will not get the deduction. But in this case, I did not deduct it in the previous year. I deducted in the next year and I deposited it in the next year, even if before the return filing date. But the deduction did not happen in the previous year, so it will not be allowed as it will not be an admissible deduction for previous year 2021, but it will yes be an admissible deduction in previous year 21-22. So for you people, question can comes in 3 ways. One, a simple straight question. Expenditure is for this year, no deduction at all. You will no TDS deduction at all. You will make a disallowance of 3 lakhs. Expenditure of preceding year was not allowed in the preceding year. What will you do? But it would be allowed in this year if it is deposited in this year or deducted and deposited in this year. Then this type of case can come. Expenditure is of previous year 2021, deducted in 21-22, deposited in 21-22 before return filing date, and immediately with seeing return filing date, what you will do? You will give the allowance. But no, the allowance will not be given. Why? Because it was not deducted in the previous year. The TDS can be deposited by the return filing date, but it anyhow has to be deducted in the previous year itself, to come it as an admissible deduction. If it is not deducted in the previous year at all, it will not be allowed as deduction in that previous year. It will be allowed as deduction when it is deducted and it is deposited. Clear? Yes or no? This is a very important point where people, especially this part, where people tend to make an error. Very good, Ambika and Preeti. So again, I'll repeat. Section 40A says that if a TDS is not deducted in the previous year, or if the TDS is deducted but not in the previous year but not deposited before the return filing date, then the expenditure 100% would be disallowed. But having said that, it would be allowed in the year when such TDS is deducted or when such TDS is deposited. Clear? Yes. But here, one thing is very interesting to attract where people make a mistake. If now Mr. A is the person, Mr. Joey. Mr. Joey, let's take Mr. Joey. Mr. A did not deduct the TDS of 3 lakh for Mr. Joey. Okay. Now I did not deduct the TDS. What will trigger? Addition will trigger, right? Addition will trigger. I did not deducted the TDS at all. Addition will trigger, yes or no? Yes. But Mr. Joey is such a nice person. He's such a diligent person. He filed his return. He filed his return in time, has taken this 3 lakh in his return amount, has paid all the taxes, has paid all the taxes in this regard. Has paid all the taxes in this regard. What Mr. Joey did. See, TDS. Why is TDS there? TDS is there so that government can ensure that the income which is being circulated on that tax is deposited, right? And that's why at source they make a liability to deduct TDS. But if the person himself, jiska income hai, whose income is that, he himself is showing that as an income, is filing the return, is paying all the necessary taxes on such income, and a certificate has been furnished by the accountant of Mr. A that everything is correct, then Mr. A would not be treated as assessee in default, and there would be no addition, and there would be no default. First of all, there would be no default. Is it clear? No addition, I will come to the point. Okay, what did I say? Mr. A did not deduct the TDS for Mr. Joey, but Mr. Joey himself showed this in the previous year as an income, filed the return within time frame, and have paid all the necessary taxes. Along with this is certified by Mr. A's accountant. Then Mr. A will not be considered as assessee in default. Number one. Number two, will the addition happen? Yes, the addition will happen. Why? Because he did not deduct the TDS in the previous year, 2021. TDS was not deducted. Joey deposited the TDS when? In previous, Joey deposited the TDS when in previous financial year 21-22. Ma'am, how? Mr. Joey, when filed the return and when paid the taxes, basically when filed the return, it would be assumed that Mr. A has deducted the necessary taxes on that date. The date when Mr. Joey has filed his return after paying necessary taxes, then only it would be assumed that Mr. A has deducted the taxes then, and hence he will be free from the tag of assessee in default. He will be free from the tag of assessee in default. Again, I'll say first, the date when the payee is who? Mr. Joey. When the payee files the return, it would be assumed at that date that Mr. A has deducted the taxes. Correct? Mr. A has deducted the taxes. So now suppose Mr. Joey filed the returns on 13th July 2021 for previous year 2021. Okay, he has filed the return on 13 July 2021. Now, when the taxes is deemed to be deducted on 13 July 2021, taxes did not get in the previous year deducted. Taxes did not get deduct in the previous year. Correct? Taxes did not get deduct in the previous year. It is assumed to be deducted only on 13 July 2021. Yes or no? Yes. That means taxes did not get deducted in the previous year 2021, and when the taxes are not deducted, it becomes the addition of the previous year itself. But at the same time, Mr. A would be allowed deduction in the previous year 21-22 on the basis of assumption, on the basis of deeming provision that, and what is the deeming provision? That when the person on whom the TDS was deducted but was not deducted by the deductor, but the payee himself has shown it as an income and has paid the necessary taxes, then the date of filing of return of the payee would be deemed to be the date of deduction of the deductor, and hence in that year he will get the benefit of or the reversal of the disallowance. Now I will read the same for you in tax language. In case assessee fails to deduct the whole or any part of the tax on any such sum but is not deemed as assessee in default. Why it is not deemed as assessee in default? By the reason that the payee has furnished his return of income, has taken into account such sum for computing income in such return of income, has paid the tax due on the income declared by him in such return, and payer furnishes a certificate to this effect from an accountant in such form as may be prescribed, it would be deemed that assessee has deducted and paid the tax on such sum on the date on which return of income has been furnished by the payee. So assessee would be deemed to deduct tax on the date when the Mr. Joey has filed his return, and Mr. Joey has filed his return on 13 July 2021. That means tax has been deducted in 13 July 2021. Now, since the date of furnishing the return of income by the payee is taken to be the date on which the payer has deducted the tax at source and paid the same, that is 13 July 2021, such expenditure or payment in respect of which the payer has failed to deduct the tax at source shall be disallowed under section 40AI in the year in which such expenditure is incurred, which is your previous year 2021. However, such expenditure will be allowed as deduction in the subsequent year in which the return of income is furnished by Mr. Joey, since tax is deemed to have been deducted and paid by the payer in that year. So to sum up, when the payee is diligent enough and you are not becoming assessee in default because of deeming provision, the tax would be deemed to be deducted on 13th July 2021, but it has been deducted in the next year. That means disallowance will happen in this year, but at the same time, you will get an allowance in the next year. This is all the crux. Any doubt from this? Once you understand 40AI, 40AIA is just a cakewalk. How is 3 lakh getting taxed twice? You think yourself as Mr. A. You made a payment. You made a payment of 3 lakhs. You deducted it in your P&L account. But since you did not deduct the TDS, it would be added under section 40AI. Okay? Under section 40AI, this would be added. So this 3 lakh pay, though you did not get any deduction, this 3 lakh would be added back. This was debited in your P&L, but now I am adding it back. But at the same time, in previous year 2021-22, whatever is your profit, whatever is your amount of profit, as a reversal of 40AI will go and you will claim 3 lakh ka deduction. So which would have been allowed 2021 May had you been a compliant tax, a TDS payer, is now allowed in 21-22. They are not taking your benefit, but they are just taking it to the year when you become compliant. As simple as that. And deduction is necessary. If you will not deduct it, even if you paid before the due date of return, if you're not deducted in the previous year, but if you paid before the due date of return, then also it will not be legitimate deduction of the previous year 2021. Ambika, is your doubt clear now? Chalo, great. Now, that's all about your 40AI. 40AIA. 40AIA covers my payment to resident. Payment to resident. This is payment. 40AI is payment, or 40A1 clause 1, whatever you like to say, is for payment to non-resident or payment outside India. This is for payment to resident. Everything is same if the TDS is not deducted or deducted but not deposited before due date of filing of return. Deducted, not deducted or deducted but not deposited, then instead of 100% of such expenditure, 30% of such expenditure would be disallowed. 30% of such expenditure would be disallowed. So let me take an example of Mr. Joey ki jagah, let's take Mr. Jagdish. Now, I am Mr. A. I had to make a payment of 3 lakh to Mr. Jagdish for consultancy. I made this payment without deducting the TDS. What would be the impact in previous year 2021? 30% of 3 lakh, that is 90,000, would be disallowed. Second scenario, if I deducted the TDS but I did not deposit it by the return filing date, then also same 90,000 would be disallowed. Second case में, if Mr. Jagdish becomes a diligent taxpayer, shows this 3 lakh as an income, file the return within timelines, paid the necessary taxes, what will happen? Again, in previous year 2021, this would get disallowed. But at the same time would be allowed in previous year 21-22. Is it clear? Whatever disallowance happen would be to the extent of 30%. And when you pay such taxes, deduct such TDS and deposit the TDS to the credit of the government, you will get that 30% as allowance in that previous year. Do you want me to take the example of payee in more depth, or is it clear? Or let me take the example which is there in your module. First example, tax on royalty paid to Mr. A resident, has been deducted during the previous year 2021. The same has to be paid by 31st July or 31st October as the case may be. Otherwise, 30% of that royalty would be disallowed in computing the income for assessment year 21-22. In respect of such royalty, tax deducted during the previous year 2021 has been paid after 31st July or after 31st October, then 30% of such royalty would be allowed as deduction in the year of payment, which is previous year 21-22. Clear? Next question. Delta Limited credited the following amounts to the account of resident payees in the month of March 2021 without deduction of tax at source. What would be the consequences of non-deduction of tax at source by Delta Limited on these amounts during financial year 2021, assuming the resident paying all the cases mentioned below have not paid the tax, if any, which was required to be deducted by Delta Limited? Previous year 1920 May, he did not deduct the tax. Now we are in previous year 2021. Salary to its employee credited and paid in March 21, 12 lakh rupees. Director's remuneration credited in March 21 and paid in April 21. Sorry, previous year 2021 May, he did not deduct the tax on these expenses. So what would be the disallowance? 12 lakh plus 28,000 pay, 30%. 3,68,400 would be your disallowance under section 40AI for previous year 2020-21. Clear? But if the tax is deducted on director's remuneration in the next year, which is your previous year 21-22, at the time of payment remitted and is remitted to the government, then the amount would be allowed as deduction in the income for the previous year 21-22 or your assessment year 22-23. Is it clear? Deduction in the same year is important to claim the deduction. No deduction, no deduction, disallowance. Deduction but no payment before return filing date, again disallowance. Deduction but payment before deduction but payment before return filing date, allowance. Deduction but no payment before return filing date, disallowance. Deduction in the later year, payment before return filing date, again disallowance. But last 2-3 sections, then I'll take a call the class off because I cannot explain monetary perquisite without a fresh mind for you people, because that is really a heavy topic. Okay, equalization levy. Again, equalization levy, just like you deduct TTS on equalization levy has also to be deducted at 6%. If not, if it is required to be deducted, and if you have not deducted or after deduction have not deposited it before the return filing date, then the expenditure would be disallowed, but it would be allowed when in the year you make the deduction and make the payment for the same. Foreign taxes which are paid are disallowed. Any income tax which are paid is disallowed. Only you get the foreign tax credit, which you will see, which you may have read in your section 1991. So foreign taxes, income taxes, all are disallowed under section 40 clause A, subclause 2. Next is 40 clause A, subclause 2B. Now what is this is, see, state government ko all the expenses are allowed. Remember, state government undertaking, if make any payment to state government, because state and government undertaking is what? It's an undertaking of the government, right? Whatever profit this government undertaking will make, it will ultimately go to the government. So what did these people started doing is, state government undertaking ko unnecessary expenditure, unnecessary billing started happening to state government. Any charges was shown that state government has paid so much charges to state government undertaking has paid so much charges to state government, so that the profit of undertaking can, taxable profit in real terms can be reduced and maximum leverage can be made out of it. So they said that any expense which the state government undertaking makes for the state government, any expense which the state government undertaking makes for the state government would be disallowed. Any expense which is made by the state government undertaking to the state government would be disallowed if it is in the nature of royalty, license fee, service fee, privilege fee, service charge, etc. Again, because they are said to be inflated expenses so that the taxable profit can be reduced. Last subclause, an important subclause, section 40 clause A, subclause 3. Any sum which is chargeable under the head salaries, if it is payable outside India or to a non-resident and the tax has not been paid thereon, not deducted therefrom, would be inadmissible. Now this is such a rigid section. This says, अभी तक TDS के लिए what were we studying? ठीक है, before return filing date से पहले if you deduct, you will get the expenditure as deduction, right? Before return filing date से if you deposit. But section 40A3 is such a tough section. They say that if you're making a payment of salary to non-resident, payment of salary to non-resident, then the TDS has to be deducted and deposited by the due date. The TDS has to be deducted and deposited by the due date. Due date means 7th of the next month. If not, salary to NR would be disallowed. If not, salary to NR would be disallowed. Number one, it will not be allowed whenever it is actually deducted. They say salary to NR has to be the TDS on salary to NR has to be deducted and deposited within the due date period. That's it. It should not go till the return filing date. It should not be deducted this year and deposited before return filing date. We will not take anything. If it is disallowed, it is disallowed. It will not be allowed again at the time of payment or at the time of deduction. The moment it is unpaid, the moment the TDS on salary to NR, the moment the TDS on salary to NR goes unpaid or does not follow the timelines, the salary would be disallowed. The salary would be disallowed and will never be allowed again, even on future compliance. Okay, so with this, I'll take off the class. Sorry if it got extended. Any topic which you want to do it right now or later, you can tell me right away. You can take a summary. You can go through the summary. I'll wait for your doubts to come. These are again, students, inadmissible deductions, which would trigger if the conditions are not fulfilled. If you do not deposit the TDS, inadmissible deduction, but yes, it would be allowed later. But the salary on NR TDS, if not deducted and deposited within timelines, will not be allowed later, would be disallowed. There is no condition for return filing date on it. Any doubt anyone has? So shall we call off the class now? Please come revising these sections, because in the next class it would be more of theoretical, and we'll be for the first half an hour we'll be taking some really interesting topics, your section 48.2 and 48.3. The remaining part of this, very important. Then we'll be covering your presumptive income and your tax audit. Tax audit mein there is a change this year, so please everyone, I request, be as participative, and before that cover as much as you can from this topic, because next class would be the wrapping up class, and I'll obviously revisit section 28 annual speculation business. So thank you so much everyone. See you in the next class. Till then, please take care of yourself, and most importantly, study, sleep well, eat well. Thank you so much.